Hello and welcome to my October economic RBA and property update. These monthly updates don't get much bigger than this one, folks. It's another jam-packed update. So strap yourself in because there's going to be plenty of data that we need to talk about. Now, my key focuses this month include the global economic outlook worsens. The new UK Prime Minister introduces a mini budget that shocks the financial markets. Interest rates are going up again, but when will the RBA take a pause on the cash rate and why? And finally, in my property update section, I'll share my thoughts on the downside risk and the upside opportunity to property values in the short term. Also, hang around to the end as I've got some special bonus education resources that I want to share with you about how you can beat the banks. All right, so let's jump into it. I want to start by looking at the global economic update first. And whilst I'm talking global markets, I am starting with talking about the US cash rate and how they are impacting the global economic scene. That's because last month we saw the US Federal Reserve add another 75 basis points to the current cash rate. And Jerome Powell reiterated they will continue their go hard on inflation stance, as they're also making no apologies in doing so. In their view, the alternative opinion or option would result in even further pain in the US economy if inflation continues to run rampant. So they're on a mission in getting inflation back to their target range of 2% by the quickest means possible, and that's using the power of monetary policy via their cash rate settings. Currently, the US cash rate now sits at 3%. Forecasters have the cash rate pushing above 4.5%. So there's still some way to go in their tightening cycle. Now, the global impact on the US's aggressive tightening cycle is other developed central banks are forced to play along, creating a synchronized and sharper cash rate tightening cycle around the world. This move is increasing the likelihood of not just a global economic slowdown, but it's increasing the possibility of a coordinated global recession to reset inflation pressures around the world. And there's nothing like a recession when it comes to slowing down inflation. Slowing global economic growth combined with higher cost of servicing debt puts increased pressure on some nations whose debt levels increased during the pandemic as they propped up their local economies during this time. This increased pressure on debt combined with the geopolitical tensions is causing the financial markets some heartburn right now, of course, in addition to the global inflation story. This uncertainty is showing up in global equities as the manufacturer's slowdown means less business profits and a reevaluation of assets, causing share prices to tank around the world, for now at least anyway. Finally, the US move is also resulting in a flight to safety in the form of the US dollar, now, which is the world's unofficial currency, meaning that foreign currencies, including the Australian dollars, are getting beaten up against the greenback. I'll talk more about this later in this update. Now, the other big news was the impact on the global money markets is what happened in the United Kingdom. We saw the new British Prime Minister, Liz Truss, introduce a mini budget to kick off her term as leader. In summary, this mini budget introduced tax cuts whilst also capping energy prices during the upcoming winter, effectively pumping fiscal stimulus into an economy, plus increasing government debt whilst staring down the barrel of record high inflation. So it's fair to say that financial markets hated this idea, and this has led to the Bank of England having to step up and start buying 10-year bonds to stabilise the money markets there, with the risk of a ripple effect into global money markets still remaining live as I record this update. With all this global economic headwinds, not forgetting the ongoing energy crisis in Europe with Russia's erratic behaviour, we saw the OECD downwardly adjust their latest economic forecast. The forecast for overall global growth was downgraded from 3.2% down to 2.2% in 2023. To highlight the shift in global growth, the OECD forecast, let's compare a couple of the countries and regions that we follow. Remembering back in December of 2021, no forecasts had Russia invading Ukraine. Starting with the US back in December of 21, their forecast growth was 2.4%. Now, new forecast is just 0.5 of 1%, with many tipping that they will fall into recession now. The Eurozone was 2.5% back in December 2021. Now the forecast is just 0.3 of 1% growth. Again, many expecting they will also fall into a recession. Germany, the biggest economy or the economic nation inside the Eurozone, is falling from 2.4% down to a negative 0.7, taking them into that recessionary area. China, 5.1% to 4.7% as their economy battles COVID lockdown restrictions. Japan is the only developed nation looking at growth next year, increases from 1.1% to 1.4%. And also bucking the trend was growth in India with a forecast of 5.7%, up from 5.5%. Now, the next few months and early into 2023 really do look very interesting indeed for the global economy. So let's leave the global economy there and see what happens over the coming months. Now, let's turn our full attention to some of the US data. I want to start with looking at GDP and productivity. The third estimate of the second quarter GDP growth was unchanged at an annualized rate of negative 0.6. However, personal consumption growth was revised up to an annual rate of 2% from 1.5% previously. Looking at durable good orders now, we see that when excluding defence and aircraft sector, durable goods orders rose by 1.3% in August, the largest increase since January this year. This was stronger than the 0.2% gain expected by consensus and followed a revised 0.7 rise in July, and that was previously up from a 0.3. This outcome suggests that business investment and the momentum across the industrial side of the economy remains robust despite a series of interest rate hikes we've seen in the US. That said, with aggressive tightening cycle continuing or now underway, it's expected that investments will scale back in 2023. The composite PMI came in at 49.3 in September, a 3-month high. This was above the consensus expectations of a 46.1 and up from the August outcome of 44.6, noting this still remains in contractory territory. The manufacturing PMI strengthened to 51.8 in September, up from a 51.5 in August. The services PMI also improved in the month, but also remained in contractory territory. It rose from 43.7 in August to 49.2 in September. Now, the Philadelphia Fed Business Outlook Index fell to a negative 9.9 in September from a 6.2 in August. Now, this is well below consensus expectations of 2.3. The fall reflected declines in new orders from negative 5.1 to negative 17.6, in shipments from 24.8 to 8.8, and unemployment from 24.1 down to 12% even. However, the index also suggested that some easing in price pressures is occurring as prices paid decline from 43.6 down to 29.8. So we're definitely seeing pricing pressures coming down, but that's also on the back of a slowing order book coming out of the Fed, the Philadelphia Fed there. On inflation, the third estimate for the core personal consumption expenditure measure, the PCE, a closely watched measure on inflation, was revised up in the June quarter. So we saw core PCE was revised up to 4.7 from 4.4 previously, but the annualized rate remained below the March quarter reading of 5.6. The final report showed US producers price, the PPI, fell 0.1 of 1% over August as fuel costs eased, but the core index rose a larger than expected 0.4. The PPI decelerated year on year, is still a high 8.7 from July's 9.8. So we are seeing a deceleration in terms of what's actually happening there, but still we've got some inflationary pressures very consistent and showing up in the US. Looking at the consumer confidence rose in September as a strong labour market and expectations of rising incomes, in addition to an easing in inflationary pressures. We just saw a bit of that showing up there, reflecting falling gasoline prices, helped buoyed by consumer sentiment against the face of aggressive rate hikes. So the consumer is trying to work out where it sits. The Conference Board Consumer Confidence Index rose to 108 in September, and that's up from 103.6 in August. Retail sales unexpectedly rose by 0.3 in August, beating consensus expectations of a 0.1% fall despite continued inflationary pressures. However, the July month was revised down from a flat result to actually be revised down to a negative 0.4% outcome. Finally, some property data. New housing demand remains robust and surprised to the upside in August. New home sales surged by 28.8% in the month to 685,000. Now, this was the strongest pace of sales since March and followed a revised 8.6% drop in July. Whilst new home sales are up, existing home sales declined by 0.4 over the month of August, taking annual sales to 4.8 million. This is the lowest annual rate of home sales since May of 2020. And this is the 7th consecutive monthly fall, which clearly shows that the higher interest rates are starting to bite in the property market. The NAHB Housing Market Index, a gauge of home builder sentiment, deteriorated for the 9th consecutive month in September, marking the longest stretch of monthly declines on record. The index dropped to 46 from 49 in August. It's the weakest reading since May of 2020. So as expected, these continued headwinds will persist in the short term for the US housing market as rates continue to climb over there. So we're seeing the existing property transactions slow. So even though new housing starts might be up, the overall market is on a downward trajectory when it comes to housing in the US. All right, that wraps up our US. Let's now look at China. China's consumer prices rose at a slower than expected pace in August, while the rate of producer inflation hit an 18-month low also. The consumer price index, the CPI, rose by 2.5% in the year to August from 2.7 annual growth in July and against consensus expectations of a rise of 2.8. The producer prices index, the PPI, rose by 2.3% in annual terms in August, down from 4.2 in July, and versus expectations of an increase of 3.2. All this inflation data indicates China isn't battling any inflationary pressures compared to developed Western economies. What they are battling is an economy that's underperforming on the back of weak domestic demand. This weak demand is a result of their COVID policies and obviously, their struggling property sector. As a result, the PBOC will allow some cities to cut mortgage rates for the first home buyers and is expanding the lending program to expedite the delivery of delayed housing projects. Latest retail data does point to an upswing in economic activity. We saw retail sales jump to an annual rate of 5.4 in August, beating consensus expectations of a 3.3% annual gain. The result improved on July's reading of a 2.7 and was the strongest annual jump in retail sales since July 2021. Although we need to be mindful that big increases and big declines have been a feature of the COVID lockdown period. So they do jump up and they jump down. The trade surplus narrowed to US $79.4 billion in August from a record $101.3 billion in July. The narrowing in the current account was underpinned by a sharp slowing in export growth. In annual terms, exports jumped 7.1% in August, down from 18% in July. This was the slowest year-on-year increase in 4 months. Import growth also softened from an annual rate of 2.3% in July to 0.3% in August. Industrial production accelerated faster than anticipated in August, suggesting a recovery in activity may be underway as stimulus ramps up. Industrial production advanced 4.2% over the year to August compared to 3.8% annual rise in July. This was the fastest annual pace in 5 months. Industrial profits over the year to August eased by 2.1% compared to the corresponding period last year. This compares to a 1.1% annual fall in profits over the 7 months to July. So we're seeing mixed messages in the Chinese economy. We're seeing some signs of life, but until they get into a more regular flow, the actual overall OECD forecast is for a decline in growth in the in the Chinese economy. Looking now at the Eurozone, as I mentioned earlier about the challenges in the Eurozone, we saw economic confidence deteriorate for the 7th consecutive month in September as households are hit with a combination of surging inflation, potential energy rationing, rising interest rates, and heightening economic uncertainties. The final estimate of inflation confirmed that prices rose by 9.1% over the year to August. This was a record high for the Eurozone and was unchanged from the preliminary estimate. Spikes in energy and food prices drove the surge. Core inflation, excluding volatile items, was also unchanged from its initial estimate of 4.3%. The European Commission's economic confidence indicator fell to 93.7 in September from a revised 97.3 in August. This is the weakest monthly reading since November of 2020. Consumer confidence was finalised at negative 28.8 in September, unchanged from the preliminary reading. The real concern here is that this was the weakest result on record going back to 1985. Activity contracted for a 3rd consecutive month as the composite PMI came in at a 48.2 reading in September. The manufacturing PMI declined to 48.5 in September. This followed a 49.6 in August. And the services PMI activity also weakened to 48.9 from 49.8 in August. The Eurozone is entering its winter months with very challenging economic conditions that have not been by their own making, but really are solely by Russia's makings. Firstly, by the invasion of Ukraine, and secondly, with its lies and deceptions when it comes to the supply of oil and gas to Europe. Now, one suspects Russia will not be liked or trusted by Europe for a long time after these events. If Russia isn't feeling isolated now, it won't be too long before they will be very isolated as a nation indeed. In rounding out the global economic news, I wanted to finish off with some commodities data, and that's on the back of obviously several months earlier I was talking about how the increased cost in oil, gas, and all of those, and food, wheat, those types of costs, all of those input costs were rising at the start of the year on the back of Russia's invasion of Ukraine. But I did mention back then that as the economy starts to slow, you would start to see some of those prices come off their recent highs. And that's what I wanted to showcase in this particular update. So let's take a look at some of those critical commodity prices. So we saw the West Texas Intermediate, the WTI crude oil, continue its downward trend to its lowest level in 9 months. Now, again, this is welcome news for falling oil prices, and that is right across the board. Input costs, transport costs, the whole thing. Lower oil prices is good for cheaper prices and lower inflation. Iron ore is also retreated from its recent highs, and that is on the back of that global economic slowdown, which then creates a lower demand for steel and those types of things. Now, ore prices may increase if China does further stimulus, but right now where it currently sits, you'll see iron ore come under downward pricing pressure. Coal prices are currently sitting off their all-time peaks, so we've passed that peak, but they are still quite elevated considering that obviously coal and energy production is absolutely critical at the moment. So you would probably see those coal prices still remaining relatively high. But the reason why they've come off their peaks is because a global slowing economy means less energy production that we absolutely need. Now, natural gas is another example that this remains elevated, but it's come off its recent records high of earlier this year because it's demand in Europe. So we're seeing a lot of natural gas being bought out of the US and potentially also out of the Australian markets to shore up energy supplies. Now that's on the back, obviously, of Russia's refusing or their erratic behaviour around supplying both oil and also gas supplies into Europe in this upcoming winter. So, but the good news is that they've certainly come off those recent peaks. Now, wheat prices also spiked at the start of the invasion of Ukraine. We talked earlier about how wheat is around 40% of the world's wheat is supplied through Ukraine in that region of the world. And so there was a real concern about a food shortage and famine and those type of things. Now, what happened was Ukraine was able to get the bulk of their wheat out through their ports whilst also trying to fight Ukraine in the war. So that's obviously meant that the food inflation story has also eased, and we've seen those wheat prices come off as well. So that's how you would summarize it. I mean, the mechanism of how the economy works is those supply areas, that crunch, that shock that we saw earlier is now starting to dissipate, and we're seeing that show up in those commodity prices. We would hope that obviously with a further global slowing of the economy, that those commodity prices will continue to come off again, meaning that supply side inflation story is going to reduce somewhat over the coming months and hopefully into the next year. Now, however, that said, we still are seeing some aggressive synchronized movement. So we're summarizing, that global story. Let's quickly recap. We are saying that the synchronized movement of central banks in developed nations around the world to follow the US lead is a given. So we're probably going to see cash rates moving higher than maybe they normally would. In addition to that, we saw the UK's decision in their mini budget really unsettle the financial markets. And what we don't want is financial markets to be unsettled and the cost of money also increasing as part of that as well. And, in rounding out that story, we've just then seen further downward forecasts on global economic growth. So this slowdown, this manufactured slowdown that we're seeing around the world is starting to play out. And that's obviously concerning many, and it's also showing up on equity markets and those types of things as we've talked about as well. So that rounds out our global view of what's happening around the world. Now let's turn our attention back home, and today the RBA board met, and we saw that the RBA board meeting today, that a surprise result with the market with a 2.5% increase in the cash rate. Now the consensus estimates was for a 0.5% increase, not a 0.25% increase. So we have now broken the trend of those monthly 0.5 increases, which started back in June this year. Not forgetting, we also had the first increase was a 0.25 back in May. In 6 months, the cash rate has moved from 0.1 of 1% to now a reading of 2.6%. With the RBA continuing its rhetoric around every meeting is a live meeting, going forward, everyone will be turning and tuning in to the Governor Lowe's commentaries or any of the assistant government's comments or speeches they have coming up this month, as we get a further read on their thinking regarding further future moves in the cash rate and when a pause is potentially coming. We know that there will be at least one pause, and that's because the RBA board doesn't meet in January. The latest forecasts from the big banks have the mixed bag of forecasts, with Westpac predicting the highest forecast cash rate of 3.6% by March in 2023, and the lowest being CBA at 2.85 prior to today's announcements. The higher the cash rate goes, the slower the economy will get, which is fanning some commentary here in Australia that we might also experience a technical recession, which is 2 negative quarters of economic growth. I'm not so sure that this is a real possibility just yet, but it can't be ruled out. And if we do see a dramatic slowing of the economy, we'll also see inflation certainly fall on the back of the cash rate coming down shortly, and that will re-stimulate the economy. Now, the RBA goal is to not overreach, meaning keeping us growing, but getting inflation under control. And that is a real tough balancing act indeed. In terms of the RBA's next move, they will be aware that the real economy is lagging in terms of higher mortgage repayments by a couple of months. And next year, there's a large amount of fixed interest loans coming out of their terms. Now, these borrowers will have a big impact in cash flow in their household budgets. Now, that's got to be playing on the board's mind, that they don't completely blow up the consumer, which will take us into a recessionary territory. Given that now this lag exists, at some point in time, they're going to need to pause to assess the future impacts of the cash rate increases they have already introduced. Now, my final point when it comes to the RBA, I want to point out what Governor Lowe said recently in some comments around inflation psychology in the community. Now, this is really important. What does inflation psychology mean when he's talking about inflation psychology in the community? It's where consumers are more likely to begrudgingly accept and pay higher prices, causing ongoing inflation. And the danger of doing this is it's harder to resist bigger wage increases, especially in the tight labour market. Now, this is referred to as price-wage spiral, meaning higher prices lead to higher wage demand, which in turn feeds through into higher prices, hence this spiraling cycle. And the net result of this inflation gets baked into the economy, and it's a lot harder to get rid of that in the short term. So it takes several years with higher inflation, where your real money doesn't buy you as much as it used to. So how do we fix this? Well, in theory, it's really easy. As a community, we just need to tighten our belts, spend less, and then we'll see, for a long enough period to show businesses that they can't keep rising prices on us. So that's that demand-driven inflation. Softer demand forces businesses to drop their prices to win our business. So falling or flat prices means inflation will be brought back under control. And as consumers, we still have the purchasing power over businesses. So therefore, in theory, it's really easy to tell everyone to do that. But in practice, because our lives have been put on hold over the last couple of years, there's a lot of household savings built up in there. So stopping folks spending is the biggest challenge here. Because if we just stop spending on those discretionary items, then that would mean businesses, in other words, we're not accepting those new higher prices from businesses. So we won't begrudgingly accept those. And so that will mean businesses will have to say, well, wait a minute, we can't keep raising our prices because consumers aren't going to buy into that. And that's ultimately that demand-led inflation. So this is a message to all of us. If we want inflation cooling off, and remembering that consumers are around 58 to 60% of total GDP, and we want interest rates to stop increasing, then we all need to commit to less discretionary spending over the Christmas period and probably for the next 6 months. If we don't, you should expect that interest rates will keep going higher until we are forced to stop spending. And that's that dichotomy. So we've got effectively a situation where interest rates will keep going up if we keep spending, right? If we don't change our spending behaviours, then ultimately the cash rate will keep going higher. If we do start to change our spending behaviours, then ultimately we will start to see the cash rate either pause and hopefully inflation and businesses not passing on that demand-driven inflation, and we will get back to a more normal society and we'll start to see cash rates coming off. Now, looking at some of that inflation data, for the very first time, we saw the release of the new monthly consumer price index, CPI indicator. Now, this is a new reading. We saw that the annual headline inflation came in at 6.8% in August and 7% in July. But because this was the very first time we're doing these monthly readings, this release only included data points from July and August. Now, the whole back series, as we move to these new monthly CPI readings, will be released in this latest reading, which will come out in October. So it's, is inflation slowing? We really can't tell until such time as we get this October reading, where all of those back series of data will be in, and then we'll start to see that monthly inflation data being more reliable. Now, in looking at other inflation data, we did see that the Melbourne Institute's inflation expectation measure fell to 5.4% in September from a 5.9% reading in August. Now, this is down off the peak of a 6.7% in May, and this is the third reading in a row showing lowering inflation expectation, which is again some really good news. Looking at our gross domestic production now, our GDP for short, the overall economy grew by 0.9% in the June quarter to take the annual rate of growth to 3.6, well above the long run average. That's what we're saying. The economy is performing very, very well. The overall size of the economy has grown from its pre-pandemic levels by 5.5% now. Yes, that's a very healthy economy, and that's what we need to do in terms of being able to slow it down. The economy is moving forward on the back of household spending, very healthy trade and new business investment in the machinery and equipment space. Households splashed out on services such as airline travel, hotels, cafes, restaurants, and recreation and culture. Now, all of these are areas that I've just been mentioning about that we do need to pull back on, the discretionary spending to slow down inflation and to also slow down interest rates. In mentioning a broader economy and the healthy terms of trades just a moment ago, we did see, and I want to spend a little bit of time talking about how terms of trade is also driving our GDP numbers, because what I wanted to shed light on is just how good digging our ground up and growing things in our ground and selling them to the rest of the world, as well as our tourism dollar, is worth to Australia. So we recorded our 13th consecutive quarterly current account surplus in the June quarter. The surplus was 18.3 billion, the fourth highest on record. The balance of goods and services, or trade surplus, increased by 16.3 billion to a record level of 43.1 billion. This was driven by a 14.7% increase in the value of goods and services exported, partly offset by a 4.6% increase in goods and services imports. It's been driven largely by commodity prices, which flowed through into strong export earnings for commodity producers. Australia's resources have benefited from higher commodity prices following Russia's invasion of Ukraine, and jumped a further 15.5% in the June quarter. Now, to give you some context, prices have almost doubled from their recent trough in the September quarter of 2020. So we talked about commodity prices earlier, and that is definitely flowing into improved economic benefits for Australia. So those terms of trade and those commodity prices are really important to us. In terms of opening up our borders to tourism again, we saw a 13.3% surge in service export volumes as international tourists finally returned here to Australia. Now, net exports contribute around 1% percentage point to our GDP growth in our June quarter result that I mentioned earlier. So in theory, the broader economy is doing very well. And so ultimately, that's why we're continuing to see these cash rate forecasts continuing to grow, in addition to what we're obviously seeing in terms of the financial markets and what's happening around the world, where this synchronized rate increases to get on top of inflation is also playing out. Now, turning our attention, I did mention earlier that I wanted to talk about the currency story. So let's talk about what's happening in the economy and how that's impacting the Australian dollar. Now, the Aussie dollar has come under heavy selling pressures since mid-August, as investors have rushed to the safety of the US dollar, given the uncertain global outlook. Now, currently the Aussie dollar is hovering around 65 US cent mark. Since its peak in 2022, which we had the currency swap rate between the US dollar and the Aussie dollar was 76.61 cents in May, the Aussie dollar has dropped around 15% and is some 4 cents below September's peak of 69.16 cents. This is despite our elevated commodity prices and high demand for those Australian commodity exports, which would usually see our dollar much stronger than it currently finds itself today. So it's a tug of war between the sheer global flight of the greenback in these uncertain times, outweighing the demand for the Australian dollar on the back of those commodity prices that we're seeing. There is some good news on the currency front, as we aren't the only currency being swamped by the US greenback from its record trading highs, which is effectively 20-year highs. Our Australian dollar is buying more pounds, it's buying more euro, yen, and New Zealand dollars. And just to give you some idea, against the pound, we are trading around our highest level since March of 2017. Against the euro, the Aussie dollar is more than a cent above its average pricing over the last 10 years. It's a similar picture looking at the Japanese yen and the New Zealand dollar. Now, this is good news if you're thinking about taking an international trip, and technically, spending that money offshore also helps us reduce our spending here, which in the short term adds to that story I was telling you about, where lower consumption in Australia, it puts downward pressure on inflation and downward pressure on interest rates. All right, let's turn our attention now to the employment story. We did see employment increase by another 33.5 thousand jobs in August, resuming a spectacular run of jobs growth after a brief intermission in July. That's almost double the 10-year average. And to put this into some context, it's a very strong result given that we effectively have a full labour market. The unemployment rate still, however, ticked up to 3.5% from 3.4%, as the number of people re-entering the labour force was larger than the increases in jobs. So unemployment ticked up by 14,000 in number terms, in real number terms. The participation rate, which is the reason why the unemployment rate went up, increased to 66.6% in August. And this is well above the 10-year average rate of 65.3, but is below the record high of 66.8 set in June. In other jobs data, we're seeing vacancy rates decline 2.1% over the 3 months to August, marking the first quarterly fall in job vacancies in 12 months. This follows an upwardly revised 14.4% increase in vacancies over the 3 months to May. Despite the fall, the number of job vacancies remains elevated and more than 2 times higher than before the pandemic, suggesting that demand for labour is still running hot. Job advertisements jumped 2% in August to a fresh 14-year high, hence that labour market running hot. This was the largest monthly increase in jobs since February, and more than fully unwinds the 1% decline that we saw in July. The result shows again that the labour market is still running very hot. Moving our attention now to consumer sentiment and confidence, we saw that consumer sentiment index rose by 3.9% to a reading of 84.4 in September, increasing for the first time in 9 months. However, consumer confidence remains deeply entrenched in pessimistic territory for now, and effectively this is a good thing in terms of wanting consumers to stop spending. The time to buy a dwelling lifted 2.9% off its recent bottoms to a reading of 80.5, although still below or well under its peaks and long-term average levels. This sentiment shift is also being reserved in recent auction clearance rates data, which is supporting over the past couple of weeks. So we've seen auction clearance rates start to improve. Buying a property sentiment is starting to improve. So this might be a general shift and ultimately could be a result of buyers activity now, because borrowing power is currently getting eroded. So these people are thinking, well, maybe I do need to jump into the market, because as cash rates continuing to increase, that borrowing power continues to keep rising, or decreasing. So that's why they may be acting now. In terms of house price expectations, lifted 3.6 in this latest reading to a reading of 100.6, with confidence coming from New South Wales and Victoria. Interesting, Queensland had the most pessimistic when it comes to price outlook. Now, this might also shift in this month's data coming up, because we did see the Queensland government scrapped their new land tax grab, their land tax policy, which was a big tax grab. So it will be interesting to see whether the sentiment in Queensland is less pessimistic because of that. And now, obviously, the Queensland market doesn't have as much of a difficult outlook because of investors potentially not coming into that market. Now, retail sales, I said last month that this is the indicator that was, my top indicator in terms of the RBA's decision to eventually pause its tightening cycle. And given, my little rant earlier about, all of us stopping our spending levels, this is going to become a critical data point in which the RBA is going to look at going forward. So they want to see retail spending slow. What did we learn last month in terms of retail spending? We saw retail spending advance by a solid 0.6 in August, but still slow from exceptional growth months that we saw in retail sales in July. So it's heading in the right direction. So it's definitely slowing, but it's still a pretty solid result. There is one challenge when reading this data, and I want to highlight this point. Unfortunately, when you do look at this data, it's released in nominal terms. Now, what does that mean? Well, it means that, it measures both changes in the price and also the quantities of sales are reflected in the data. So we can't tell if the reason for the increase is because prices have risen due to inflation or just higher general demand overall. So in theory, if volumes counted for a larger share of the monthly increase in spending, then this may be a sign that household demand remains solid and would support a case for the RBA to keep moving interest rates higher and potentially more aggressively. Alternatively, if only rising prices are the dominant driver of spending and volumes are starting to lose momentum, like I mentioned earlier, this is a sign of a slowing economy, and this makes the RBA potentially think twice about their next rate move. One still needs to be mindful if prices are continuing to rise, this is a sign that inflation could still be hanging around and rates will need to go higher. And again, this is why reading this data set is quite difficult, because if inflation is baked in, then it'll show that retail sales continues to keep growing. But if we obviously slow that demand level down and that buying demand level down on all discretionary, then ultimately we'll start to see negative retail sales results, and that will assure us that inflation isn't necessarily showing up in those numbers in as strong a fashion as it currently is right now. Okay, let's change pace a little now. Let's talk about business activity. So we saw the business conditions read was a +20 and the confidence read was a +10. Both are above their long-term averages. The data shows that this was particularly evidenced in the consumer-facing sector, such as retail trade, accommodation, hospitality services, as consumers continue to spend big. I did mention that we do need to stop this, didn't I? So please take note. Anyway, businesses are pushing their productive capacity to the max to keep up with demand. Capacity utilisation remains close to the record highs recorded in July this year, despite pulling back slightly. Now, growth in labour and purchases, or input costs, eased over the quarter to August. However, growth in final product prices, including final retail prices, showed no signs of easing. This suggests that businesses are confident enough to pass on costs to protect margin. Again, people, coming back to the theory of inflation psychology, the message we mentioned earlier, we can't begrudgingly accept these higher prices, because if we do, then ultimately interest rates will continue to go higher. So we need to say no, and we need to push back, and we need to potentially say no to those purchasing decisions. If we do so, that will bode well for lower interest rates and also lower inflation. So another big message there to all those listening along. Now, I want to talk about the property update. Now, the theme for the property this month is that the general sentiment around property is one of a stabilising of the market. I mentioned early in that Westpac Melbourne Institute sentiment survey, I pointed towards an upswing in property market confidence noting that it was also coming off a low base. Now, in support of that, we saw that the latest Property Council ANZ survey on property sentiment also stabilising, but again, at a lower level than its longer term trend. So I think what we're saying there is the panic in the market and the concern in the market, that's what it's telling us. It's potentially telling us we've passed that shock level. And in terms of the general population, we are now moving towards this understanding that interest rates are going to get higher, that the media hype around property price crashes are having less of an impact on our psychology right now when it comes to property. That said, they're still not out of the woods yet. The prospects of further increases in interest rates are clearly seeing sentiment remain below their long-term trends. It will be very interesting indeed to see what happens to general property sentiment once the RBA does actually pause their tightening cycle. I suspect sentiment will be boosted by this move once the RBA does take a pause. When that happens is really the $64 million question that we don't have an answer to. Let's now look at the latest property index results for CoreLogic's data for September. And picking up on our improving sentiment story earlier, we see the speed at which prices are falling is slowing, which is good news. CoreLogic reported a further fall in housing values through the first month of spring, with the National Home Value Index, the HVI, recording a negative 1.4% decline in September. This rate of decline has eased from a negative 1.6% fall in August. The loss of momentum in the pace of value declines was evident across most of the capital cities and broad rest of state regions. With a few exceptions, housing value falls accelerated in Adelaide and Perth this month. However, both cities continue to record only a mild reduction in values relative to the other capitals, down -2 and down -0.2 and -0.4 respectively in September. Sydney's monthly rate of decline eased from -2.3 in August to a -1.8 in September. Melbourne tapered from -1.2 to -1.1, and Brisbane falls were from -1.8 to -1.7. Darwin remains the only capital city where values haven't started the trend lower, although dwelling values still remain negative 10.1% below their peaks of 2014. Let's have a look, and I'll summarise that data again. We saw Sydney -1.8 for the quarter, -6.1, Melbourne -1.1, -3.7 for the quarter, Brisbane -1.7 for the quarter, -4.3, Adelaide -0.2, positive 0.1 for the quarter, Perth -0.4 for the month and -0.4 for the quarter, Hobart -1.4 for the month, -4.5 for the quarter, Darwin flat and positive 1.4 for the quarter, and Canberra -1.6 and -4.4 for the quarter. Combined capitals -1.4 for the month, which we heard earlier, and -4.3 for the quarter. Combined regional -1.3 for the month and -3.6 for the quarter. So nationally, -1.4 for the month, -4.1 for the quarter. Now, in upcoming updates, I'll go into a more of a deeper dive there. But earlier in this update, I promised to talk about the current downward and upward pressures, or upward optimistic pressures, on the property market, at this moment in time. So I want to these are brief summaries, but I just think it's important that we talk about these because it's a good reminder for us in terms of what's actually out there happening and what factors are playing a role when it comes to those pressures. So let's briefly look at a summary of the downward pressures. The most significant of which doesn't come as any surprise. We are talking about interest rates. The higher they go, the more downward pressure they put on values in the short term. They also reduce borrowing power, and this reduces the level of demand in the market, as well as force sellers to potentially meet the market if they do need to sell. This is because borrowers are restricted in the levels that they can bid up to. So overall, that does put downward pressure on prices. Next, in terms of the general slowing economy, we usually see an uptick in unemployment. So job security will limit further demand, albeit unemployment will still remain pretty low, even if the economy does slow. But we've just got to factor that in. Government interference. We saw the potential risk of the Queensland land tax and what it would do to investor confidence. And, the tenancy reform policies that we're seeing rolling out in states is creating uncertainty and impacting the confidence of investors. So governments can really affect markets when they start to manipulate the marketplace. And this remains an ongoing risk, especially for investors. Picking up on the government intervention point further, we see APRA and the Council of Financial Regulators are currently negatively impacting the market in terms of their 3% buffer rate when it comes to serviceability, especially when rates have moved off their emergency settings. So this is limiting the ability for consumers in terms of their buying power right now and their borrowing power. And it's limiting them buying property and also limiting them refinancing to a better deal at the moment. So they're really the main factors when it comes to the negatives. So interest rates, borrowing power, slowing economy, government interventions, and general population and property sentiment, general population sentiment around property. Now that's moving off its bottom, but so there are some positive signs there as well, which is a nice little segue in terms of talking about, or briefly talking about, some of the positives that we can see in the market. So starting with housing supply. Traditionally, the spring season, we'd see more supply coming onto the market. Now, this has not been the case this year, and as such, we are seeing tighter supply is potentially holding up values a bit further. So no forced selling yet, tight supply that's holding up values at the moment. Add to this, slowing of new builds, especially in the medium and high density apartment sector. Now, this is going to add to the growing story of the potential housing shortages that we are going to see show up in the next 12 months to 24 months. And it will take time for this new stock to come to market. So we will see certainly a real shortage of houses into the future. So again, strong demand, low supply, that's going to put upward pressure on prices. Improving rental yields. Some of this improvement is just falling prices, so we don't necessarily want to be misled by that, but also rents are also going up, and that's covering the increased costs of holding those properties. So overall, this means yields will increase. These higher rental yields may attract new investors to try their luck in the market, given the uncertainties in the share market that we're seeing of late. Now, improving rental yields will also be a result of increased rental demand on the back of increased immigration to Australia. So this year alone and next year, we're going to have around 195,000 new arrivals over that next 2 years. And these new arrivals will usually rent before they buy. And this will add to the improving rental yield story and also for the demand for property. Low unemployment. So I mentioned a slowing economy is a negative, but on the whole, employment will be quite strong over the next couple of years. And high employment is a net positive for overall demand for property. Higher wages. Whilst higher inflation is never good news for broader economic growth and the standard of living for people within the economy, higher wages is generally good news over the longer term as it increases borrowing power. So once inflation is brought back under control, wages don't actually go backwards, again, meaning that borrowing power will increase and that will further increase demand for housing. Interest rates will eventually peak and then come off those highs. The RBA has indicated that the neutral rate is around 2.5%. So that means retail rates in the mid-4s to early 5s will be hopefully the norm when the cash rate adjusts down again after this economic slowdown that they're manufacturing at the moment. Now, that will also see increased borrowing power and potentially bring more people to the market. And finally, in terms of the positive, we're currently in a market where there are markets in markets. I've talked about this in other updates where, in certain markets in the short term, confidence is keeping buyers out of those markets. It's keeping them on the sidelines. Now, this is an opportunity for other buyers as it's easier to buy better properties under less competition. So one thing you need to understand that buying counter-cyclical is sometimes where the smart money is at, especially in our bigger cities, as their prices continues to fall. So let's recap on some of the positives that I briefly outlined there. We see low supply and slowing supply of new stock coming to the market. Now, this is going to cause housing shortages, and as demand comes back, this is going to put upward pressure on prices. Rental yields also on the rise. Increased immigration and growing population equals increased demand for housing and rental stock. There's still pretty strong economic outlook, so that is good for employment. Higher wages, lower interest rates, improve borrowing power, and less buying competition right now. So how do I summarize that? Well, whilst there's still headwinds in the property market sector right now, if you think beyond this short term, the property story improves where we can clearly see demand for property growing, and this will put upward pressure on prices when this demand starts to materialize. Certainly some food for thought in terms of when you might be thinking about getting into the market. Now, I've always taken a long-term view and recommended that that viewpoint to anyone who's willing to listen. Take that long-term view, people. Okay, home stretch. And in closing out this month's update, I promised you some bonus educational content. And this is related directly to interest rate and to the home loan marketplace. Hopefully, you all know by now that we have a free financial and goal-setting platform, online platform called Moorr, and that's spelled MOORR. And this is where you can achieve more with more. Anyway, last week I created a group of new educational videos designed to help you beat the banks when it comes to understanding how the competitive lending market works and to ultimately help you find the best deals. Now, whether that's for refinancing an existing mortgage to get to a better deal or setting up to buy a new property. Now, in total, there are 9 videos, and here's the topics that I'm talking about. How do banks profit from mortgages? The problem with comparison rates. Do lenders really put mortgages on sale? How negotiable are published rates? Are mortgage discount rates misleading? Loyalty tax, what is that? What do bank retention teams do? The complexity you need to know, and there's also a bonus video in there as well. Now, you can watch one or you can watch all of them, and they're all part of a Don't Leave Money on the Table series of educational videos that I've been putting together for the Moorr community to help you save money and to make sure that you're putting your money to work harder for you and your future. Now, they're free to watch, and you can access them right now from this link at moorr.com.au/beatthebanks. I've really enjoyed putting these content together, and I hope you get the maximum educational benefit from it. Because remembering the home loan market is really competitive at the moment. There are lots of cashbacks and bonuses and really sharp interest rates. So if you've had your loan for a couple of years, you may be surprised at just how competitive new rates are compared to existing rates. So please check that out, because potentially you could save yourself thousands in saved interest costs when it comes to looking at your mortgage. Well, that was a really big show. It's a big update. We covered off on so much ground in terms of global economic outlook and the uncertainties we saw there. We covered off on what's going to happen with interest rates and what's going to be the trigger for the RBA. So the trigger is going to be reduced spending, which is indicating a slowing economy, which means they will be able to take a pause in terms of their cash rate cycle. And obviously, from a property point of view, we're probably getting used to where the cash rate and retail interest rates are going to be. And so the property market is easing in terms of its current correction as well. So, there's still a lot of unknowns out there in the marketplace. I look forward to the next update in November. But until then, remember, knowledge is empowering, but only if you act on it. So we'll see you next month.